Welcome back to the Ticker Podcast, everybody, your Monday morning edition covering major financial magazine headlines.
You got it.
Everyone ready for a deep dive?
Let's do it.
Okay, so think of us as your personal Blinkist for today. We've got the Wall Street Journal, Bloomberg, and CNBC all lined up so we can unpack some intriguing global market trends and get you on with your day.
Sounds good to me.
Yeah.
And what I find really interesting is how these seemingly separate stories we're going to cover are actually all kind of intertwined. We're seeing this ripple effect across markets influenced by political shifts, economic policies, even some big corporate shakeups.
Absolutely. So let's jump right in and we'll start with China. Wall Street Journal is reporting that China's consumer price growth basically slammed on the brakes in November. Yeah. Their CPI only rose 0.2% year on year.
Wow.
Yeah, and that fell short of the 0.5% economists were predicting. But even more telling is their producer price index, which has been on this downward slide for 26 months straight, dropping yet another 2.5%.
Yeah, those figures really paint a picture of weak demand in China despite all the government's efforts to try and stimulate spending. Seems like they're fighting an uphill battle there, especially with the ongoing property downturn. The Wall Street Journal also mentioned that new home sales at China's top 100 developers fell almost 7% last month.
So what's the plan now? Where do they go from here?
Well, Bloomberg is reporting that China's leaders are signaling a much bolder economic stimulus plan for 2025. They're talking about a shift from a prudent to a moderately loose monetary policy.
Okay, so what does that actually mean, moderately loose?
Well, it could mean we see more rate cuts from China, which would then impact interest rates globally. They've also hinted at a more proactive fiscal policy, potentially leading to a wider fiscal deficit and, more government borrowing. To be honest, this is some of the most direct language we've heard from China about stimulus in years.
Wow, so they're really trying to make a statement. And the markets are definitely paying attention. Bloomberg reports that the offshore yuan actually strengthened on this news. Investors seem to be betting on a Chinese economic recovery. And it looks like the ripple effect is extending beyond China's borders. The Australian and New Zealand currencies are also getting a boost.
Yeah, China's influence on the global economy is just undeniable. But, there's a sense of cautious optimism here, I'd say. Some economists believe that simply injecting more stimulus won't be enough. They argue that China needs to shift its focus towards boosting domestic consumption for a truly sustainable recovery.
Yeah, it's a real balancing act, right? They need to find a way to stimulate growth without making their debt situation even worse. It kind of makes you wonder if their previous export-driven growth model is reaching its limits.
It's a good question. And while we're on the topic of economic growth, Japan is also making headlines. The Wall Street Journal reports that their economy expanded faster than expected in the July-September quarter.
Oh, that's a nice surprise. Tell me more.
Well, their GDP grew by an annualized rate of 1.2%, which actually exceeded the initial estimates of 0.9%. Upward revisions to capital investment and exports seem to be the driving forces behind this positive surprise.
So does this mean a potential rate hike from the Bank of Japan is on the table?
This growth definitely strengthens the case. The Bank of Japan governor has been hinting at potential rate increases as the economy improves, and this latest data could give them the green light. We've already seen the yen strengthen against the dollar following this news, jumping from 150.10 to 149.70.
But I'm sure Japan's economic recovery isn't without its challenges.
Of course, the Wall Street Journal points out some potential headwinds. The global economic slowdown, particularly in China, is a major concern. And then there's the lingering uncertainty around potential trade tariffs under the new U.S. presidency.
Right. And those domestic political considerations that the Wall Street Journal mentioned could definitely influence the Bank of Japan's decision-making process. Seems like they have a lot to juggle. All right, let's switch gears completely for a minute and talk about advertising. The Wall Street Journal dropped a bombshell today. Advertising giants, Omnicom and Interpublic, are in advanced talks to merge.
Wow, this is huge. This potential merger would create the world's largest advertising company, surpassing WPP?
Yeah, and the Wall Street Journal reports that it'll likely be an all-stock deal, potentially valued between $13 billion and $14 billion, excluding debt. The combined entity would have over $20 billion in net revenue. This would be a landmark deal, the biggest the advertising world has ever seen.
I think what's driving this merger is the rapid evolution of the industry. Technology, data, and AI are transforming the advertising landscape. And both Omnicom and Interpublic are feeling the heat to adapt.
It's interesting. The Wall Street Journal even mentions that generative AI is posing a threat to traditional agency roles. This merger could be a strategic move to stay ahead of the curve and remain competitive in this new era.
It's a classic case of adapt or die. And we're seeing this consolidation trend across industries as companies grapple with the digital revolution.
It is interesting, though, that the Wall Street Journal points out the contrasting performance of the two companies. Interpublic has been losing business lately, while Omnicom seems to be in a much stronger position. That might explain why Interpublic is actively seeking a sale.
It's a good reminder that even within a massive industry like advertising, individual companies face unique challenges. This merger could be a lifeline for Interpublic. However, the integration of two distinct company cultures is something to watch closely.
Good point. Okay, let's zoom out for a second and look at the broader global market dynamics. CNBC reports that all eyes are on the Canadian and Australian dollars this week as we approach their respective central bank meetings.
Right, the markets are already anticipating a deep rate cut from the Bank of Canada. As for the Reserve Bank of Australia, expectations are that they'll hold rates steady for now, but potentially soften their tone on growth targets.
And what about the U.S. dollar? CNBC also had an article on that.
Well, analysts believe the dollar's recent rally is losing steam, especially with a Fed rate cut looking increasingly likely. All eyes are going to be on the U.S. inflation data coming out this week. It could be a deciding factor in the Fed's decision-making.
Speaking of inflation, gold prices are on the rise. CNBC reports that spot gold gained 1% to reach $2,657.98 per ounce.
This is driven by a couple of factors. First, China's central bank has resumed purchasing gold after a 6-month pause. And second, the anticipation of a Fed rate cut is making gold more attractive as a safe haven asset.
Makes sense. And it's not just gold. Oil prices are also seeing an uptick. Brent crude futures rose 1.18%, and WTI crude futures increased by 1.35%, according to CNBC. What's fueling this climb?
It's a few things, actually. China's move towards monetary easing has boosted market sentiment. There's also heightened uncertainty in the Middle East following the fall of Syrian President Assad, which is adding to price support. Then we also have to consider Saudi Arabia's price reductions for Asian buyers and OPEC+'s decision to extend production cuts until April. All these factors are shaping the oil market dynamics.
Okay, before we move on to a couple other interesting stories, let's talk Bitcoin bargain. Bloomberg reports that Bitcoin ETFs have seen inflows close to $10 billion since Trump's election win.
This surge is likely tied to the expectation that Trump's crypto-friendly policies will create a really favorable environment for the market. However, it is worth noting that Bitcoin has been quite volatile recently. It hit $100,000 for the first time, but then experienced some swings.
So what's the outlook then for Bitcoin and the broader crypto market?
It's hard to say for sure. New catalysts and sustained momentum will be crucial. We're still in the early stages of this market, so it's best to prepare for more twists and turns.
Now let's switch gears and dive into an interesting development in the private credit market. Bloomberg has an article about Alcentra, a private credit firm owned by Franklin Templeton, facing some headwinds.
They used to be a major player in the European direct lending market, but their corporate direct lending franchise has shrunk by half since 2020.
Wow, that's a steep decline. What's at the root of this downturn?
The article points to a few contributing factors. There were some leadership changes that didn't quite go as planned, and then a subsequent exodus of staff a few years back. On top of that, some of their investments just didn't pan out as they'd hoped, and it seems they're now struggling to raise money for a new direct lending fund.
So what does this mean for Alcentra, and what are the broader implications for the private credit market?
Well, for Alcentra, it's a cautionary tale. They were once pioneers in this space, but the recent struggles show how quickly things can change. It highlights the importance of adaptability and sound decision-making in this industry.
What about for the broader market? What does this tell us?
It suggests that investors are becoming more discerning and risk-averse. They're looking for consistent performance and stability, and they're gravitating towards the bigger players who have a proven track record. The article even mentions the possibility of zombie funds emerging in the private credit market.
Zombie funds? That sounds ominous. What exactly are those?
Basically, these are funds that are stuck. They're holding on to a bunch of illiquid assets, but struggling to raise new capital to make new investments. They're just kind of limping along, unable to grow or generate significant returns.
So for someone interested in investing in private credit, what's the key takeaway here?
Due diligence is absolutely essential. Don't just chase the highest returns.
Well,
Thoroughly research the firms you're considering and their track record. Look for those with strong management teams, a clear investment strategy, and a history of delivering consistent results.
okay, moving on to the stock market. Bloomberg also has an article about China's announcement of a looser monetary policy, which initially gave the markets a boost. It seemed like kind of a sugar rush, right? The market got all excited, and then reality set in.
Yeah, exactly. U.S. equity futures initially climbed on the news, but then those gains kind of evaporated as investors shifted their focus to some looming geopolitical risks.
So what kind of geopolitical risks are we talking about here?
Well, the situation in the Middle East is a major concern, as the Bloomberg article highlights. The fall of Assad's regime in Syria has created this power vacuum, and the uncertainty surrounding what happens next is making investors nervous. And then you've got the political deadlock in South Korea with another impeachment vote against President Yoon Suk-yeol on the horizon.
So it's like a mix of political instability and uncertainty that's casting this shadow over the markets. And to add to the complexity, we've got a whole bunch of central bank meetings coming up this week in Europe, Canada, Australia, and Switzerland.
Right. The European Central Bank is widely expected to cut interest rates, as are the Bank of Canada, and the Swiss National Bank, Australia's central bank, on the other hand, is likely to keep rates steady for the time being. These decisions will definitely send ripples through the market, so it's going to be a busy week for sure.
And let's not forget about the U.S. inflation data coming out this week, which could be a game changer for the Fed's decision on whether to cut rates in December.
Absolutely. The CPI report will be scrutinized by investors around the world. If inflation comes in hotter than expected, it could throw a wrench in the Fed's plans and inject more volatility into the markets.
Seems like every week brings a new wave of economic news to digest. For our listeners who are feeling a little overwhelmed by it all, what's the most important thing to remember?
I'd say stay informed, but don't let the headlines dictate your emotions. The markets will always fluctuate. The key is to have a solid long-term investment strategy and stick to it.
That's great advice. It's so easy to get caught up in the day-to-day noise.
Yeah.
But keeping the big picture in mind is crucial. Now let's circle back to the Bloomberg article and talk about a couple of specific stocks that are making waves. Turkish construction companies seem to be attracting a lot of attention.
Yeah, investors are betting on these companies to play a major role in Syria's reconstruction efforts now that Assad's regime has fallen. It's definitely a calculated risk, but it could yield some significant returns if those reconstruction projects get underway.
It's a good reminder that even in times of global uncertainty, there are always opportunities for those who are willing to make calculated bets. The Bloomberg article also highlights that Apollo Global Management and Workday are poised to join the S&P 500 index, which is a pretty big deal for those companies.
Absolutely. Being included in a major index like the S&P 500 enhances a company's visibility and often attracts new investors. It's seen as a mark of prestige and financial strength.
On the flip side, NVIDIA, the AI chip maker, is facing some scrutiny in China. Bloomberg reports that there's an investigation into whether they violated anti-monopoly laws. This is definitely something to keep an eye on.
It is. China's crackdown on tech companies has been a recurring theme, and NVIDIA is the latest to find itself in the spotlight. The outcome of this investigation will be closely watched.
Seems like there's always something happening in the tech world that has global implications. It's a dynamic landscape that can be hard to keep up with. Well, we've certainly covered a lot of ground today. From China's stimulus measures to Japan's potential rate hike, from a mega merger in the advertising world to the latest developments in the crypto world, it's been a whirlwind tour of the global market.
It really highlights how interconnected everything is. Politics, economics, technology, they're all interwoven, influencing each other in fascinating ways.
So for our listeners who want to stay ahead of the curve, what's the best way to keep up with all of these developments?
I'd say it's a multi-pronged approach. Read reputable financial news sources, follow industry experts on social media, and don't be afraid to ask questions. The more you learn, the better equipped you'll be to navigate these complex markets.
That's great advice. And remember, investing is a marathon, not a sprint. Don't let the daily fluctuations in the market distract you from your long-term financial goals.
Exactly. Stay focused, stay informed, and stay patient.
Well said. Thanks for joining me for this deep dive into the financial markets.
It's always a pleasure.
And for all of you listening, we'll see you all tomorrow morning with new headlines from major financial magazines. Until then, happy investing. And speaking of staying informed, one more thing that caught my eye in that Bloomberg article was the performance of gold. It seems like it's been having a stellar year.
Yeah, it has. Gold is on track for its best year since 2010. The combination of China's renewed appetite for gold and the expectation of a Fed rate cut is really driving its appeal as a safe haven asset.
Yeah, it seems like in times of uncertainty, investors just flock to gold. Speaking of safe havens, what about the U.S. dollar? It's traditionally been seen as a safe haven. But CNBC reports that analysts believe its recent rally might be running out of steam.
That's right. With the possibility of a Fed rate cut looming, the dollar is losing some of its allure. Investors are starting to look elsewhere for stability and returns.
So if the dollar weakens and gold continues to shine, What does that mean for the average investor?
I think it really reinforces the importance of diversification, you know? Don't put all your eggs in one basket. Having a mix of assets, including stocks, bonds, real estate, precious metals, can help mitigate risk and protect your portfolio from market fluctuations.
That's a great point.
Yeah.
It's all about spreading that risk and not being overly reliant on any single asset. Now, before we wrap things up, I want to touch on one more interesting development that CNBC highlighted. It seems like there's a growing focus on ESG investing. That's environmental, social, and governance investing.
ESG investing is definitely gaining some serious momentum. Investors are increasingly looking beyond just traditional financial metrics and considering a company's environmental impact, social responsibility, and corporate governance practices.
So it's not just about profits anymore. It's about investing in companies that align with your values and contribute to a more sustainable future.
Exactly. And this trend is likely to continue as more and more investors recognize the importance of sustainable investing. It's a shift from short-term profits to long-term value creation, taking into account the broader impact of investments on the environment and society.
It's a real shift in mindset, and it seems like it's here to stay. Well, we've covered a lot of ground today, exploring a wide range of topics from China's economic stimulus to the evolving landscape of the advertising industry.
Yeah, we've seen how these seemingly disparate events can have a ripple effect across global markets, emphasizing the interconnectedness of our world. It's a fascinating time to be following the financial markets.
It certainly is. There's always something new to learn and analyze.
Mhm.
So for our listeners who are eager to continue their deep dive into the world of finance, what parting advice would you offer?
I'd say stay curious, stay engaged, and stay informed. The world of finance is constantly evolving, so continuous learning is essential.
Great advice. And remember, every day brings new opportunities to learn and grow as investors. Thanks for joining me for this deep dive into the global financial markets.
It was a pleasure discussing these topics with you.
And for all of you listening, we'll see you tomorrow morning with new headlines from major financial magazines. Until then, happy investing.